Hello everyone, Steve Lynch here with Discover Options here at OptionVue Systems. Welcome to this presentation of an introduction to options and options trading. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Options trading involves substantial risk, and full understanding of these risks should be attained before embarking on any options trading venture. And today I'm going to show you some back-tested results. And so there we have to do the disclaimer too that past results are not necessarily indicative of future performance. All that stuff at the beginning, and just to welcome everyone. I'm so glad you could join us. OptionVue has been in business since 1983. 1983, primarily involved in the high-end options analytics field, high-end software that really helps traders take things to the highest level possible with the tools at the most sophisticated level available to the trading public. To find something more sophisticated, you'd have to go inside hedge funds where they have hired their own tech people to customize stuff within. And so that's kind of where we've been since 1983, and it's just a great place to, it's a great little niche to occupy. By the way, Jim Graham is with us. He's under the moniker OptionVue Webinars. And if you have any questions during this presentation, just go to the chat field, type them in, hit send. Everyone will be able to see your question, but Jim will then answer questions as I go along through the presentation here today. All right. By the way, Discover Options is the educational arm of OptionVue. We've been in business as part of that since, well, for a better part of 10 years now, a little over 10 years. And we primarily focus on the one-on-one mentoring experience, and we'll get to that in a little bit. Take a look at a few equity curves that really show you some of the possibilities with options trading. And I'm showing you here an equity curve of an advanced trading approach that we teach in our mentoring curriculum. And these are hypothetical returns, and we do a lot of that here because we really because we have the tools to do it, and we believe in it as a way of really getting confidence and helping us. And more about that as well. But what you'll see here is that with $100,000 invested, and you don't have to have that much to do this particular strategy, you'll see that in the course of 2 years, 2016 and 17, the annualized return there was 59.9%. And it didn't even start until mid-February, and for good reason. We have some technical filters that we use as well as, in some of our options trading strategies. But this is what we would call, this is a result of a strategy that many people call income type trading, where you're selling option premium. But I just want to show you this because down the road, if you're a beginner now and you want to arrive there, it'll take some, months of study to get here, but it is possible. And so we really like to take folks to that level where you can participate in something like this. And for the very beginning folks, in the course that I'm going to show you about in a little bit, we have an overlay system of covered calls, protective puts, married puts, collars, etc., where you could take a set of long equities, and this is what institutions use options for. And here's just an example. This is straight from a screenshot from one of our beginning sessions here, where we're looking at the NASDAQ in the dark blue, and you could see back in 07 into 08 how much it just completely crashed. Beginning in 07, it went up to a positive 25% before the end of 07, and then it went from being up 25 to being down 40% in the course of about 13 months or so back in 08. That's the dark blue you see there. And one thing we've done, and this is just how options are used so often, is to create hedges for institutions and big-time money managers who really want to reduce the risk and reduce the level of volatility of owning all these long stocks. And so we have 3 different overlays that we cover in our particular approach. You'll see them in purple, green, and then blue. Whereas if you go to the most conservative approach here, yeah, you would have been up 15% at one point instead of up 25. But then on the downside, you would still have made 5% instead of being down at one point 40% there. And so this is the power of options, is to create overlays on your long holdings to greatly mitigate risk, greatly reduce the level of volatility of your equity curve of your long holdings. So that's something that we teach as well. But that's just an introduction to the power of options, and we're going to get into actually the intro to options that we discussed. Philosophy and option basic. Let me touch on our philosophy first, then we'll dive into option basics. Before, just full disclosure, more details on this later, we have an introductory course that gives you 3 mentoring sessions. It's 3 months long, a ton of just literally hundreds of hours of videos if you want to dedicate the time, and a whole bunch of other benefits here, including software and data and everything. But I'll discuss this with you at the end when we dive into the details, and so you'll have a better understanding of an appreciation of some of these items here. Here's our philosophy. I'm a youth football coach, and I just graduated up. I'm teaching high school now, and football, helping out with a local school on their football team. And in the world of football, no team goes from basically the first day of practice to being on Monday Night Football. No NFL team does that. No football team, immediately arrives at Monday Night Football quality without a lot of work and a lot of progression. And trading and football are very similar in the sense. Football is a physically contactive sport, very violent. In trading, it wreaks havoc on your emotions. It's similarly emotionally violent, and you really have to prepare yourself for both. And in the world of football and trading, here is the progression that we espouse and have found very helpful for countless traders that have come to us. First is the learning process, okay? And then you practice, and then you scrimmage, and then you play. Learning is, in the world of football, the team has a chalk talk first. You go over the plays in a classroom setting with the big playbook there, and the NFL team is going to take some time and do some book work in the classroom. Then you hit the practice field, and you're going to do drills out there. You'll do blocking drills, tackling drills, get your skills going. And then finally, once you get it all down where you're practicing your plays and you've done your drill work, now you actually start having scrimmages against each other. And you can dial up the NFL network, and what do you see? In the springtime, in the spring and summer, before the fall, you'll see 7-on-7s. You'll see the Chiefs and the Broncos maybe getting together for some 7-on-7 work, and then they go to 9-on-9s, then 11-on-11s. So they're scrimmaging each other in a very casual environment. It's not formal. Finally, they're ready to play their first day. They'll do, of course, they'll start out small, with exhibition games, and then work their way up to Monday Night Football. It's a progression. Likewise, in trading, it's the same way. In the world of trading, to learn, okay, we give you recorded lessons, and you can go to YouTube. There's countless things you can watch to get recorded information. Now, we give you homework as well, and then we want you to meet with our mentor to go over your homework and make sure you have a full understanding and you've learned the concepts. Also, we give you software tutorial videos to get you up to speed and get you the information. Plus, we have an archived, probably about 400 hours of archived inside wire sessions for you to look at as well. So just learning, getting the information is not the problem here. Okay, we like to do it in a very controlled way so you don't waste time. What do you do after you learn? Now it's time to practice. And in the world of trading, you want to practice just like a football team is in a casual environment on the practice field by themselves. You want to be by yourself using a back trader type tool. And in OptionVue, we have a wonderful tool that has historical option prices going back to January of 2000. I don't think anyone has historical options data going back that far where you can experience 9/11 and the summer of 2002 and working forward, the flash crash of May of 11 or something, right around there. I mean, just all these shocks that you can experience. You can see that in BackTrader and just drill yourself with real historical option prices. Okay, and for us, we give homework where we walk you through doing this. It's very important to us that you, in a disciplined way, back test your approach. Okay, And then after this, you start paper trading strategies in real time with no money on the line. Now, after you've learned and you've practiced and you're familiar with the given strategy, it's now time to scrimmage. It's not time to go full time yet, Monday Night Football. Now you trade very small lot sizes to gain experience so that you get familiar with your options broker's platform, so that when you see prices represented, you know what's being represented and you don't click the wrong button to sell when you meant to buy and buy when you meant to sell. Okay, that's happened to everybody, it seems. Okay, you got it. Trade small, get familiar with the platform, because it's not as easy as just going long. You're buying stock, selling stock. Okay, it's a different. There's some differences. So you scrimmage with small lots, and then you start ramping it up, so that then eventually you're able to adjust your position size something more commensurate with your account level. Okay? And you want to show to yourself that you can obtain consistent gains using your particular approach. That's the way of the gridiron. That's the way we do it here, and we've had great success taking folks to a strong level of their options trading. Every strategy, okay, has a progression here where when you go into a given option strategy, you should know exactly what you're going to do. Like in football, you have a play. Here's a single wing play. And the strategy here is that we're going to run that thing. Where is this? There we go. You're going to run this off tackle play until they adjust their linebackers over, and then you come back with the counter the other way. Likewise, in an option strategy playbook, you want to know what play you're going to run and then what your result is and what you're going to do to adjust. We have income strategies. I talked about that a little bit. There are speculative directional things you can do. All right. And then there's risk management overlays. And you kind of have to understand what you're going to use options for. What are you going to use options for? Risk management overlays over your long stocks? Do you want to be an income trader? Okay. Or do you want to really, shoot for some huge returns using speculative directional strategies? That is something you need to know. And then once you know that, you can now start planning your particular trading plan and establishing what your beliefs are about the market. We ask that you do that when we get started, and we help you walk through your trading plan so you know exactly what you're going to do when the market makes a certain move. Okay, you want to think 2 moves ahead, and we're here to help you do that. Okay, let me get a sip of coffee. Let's go into option basics. 1 second. All right. Options history. Then we're going to show you an example of options using real estate, and then we're going to talk about understanding calls and puts. Again, this is the beginning. This is the intro to options. Intro to options. I'm assuming that you guys really don't know much about options. So for those of you that know a lot, this is going to seem kind of elementary, but that's kind of what the course is about right now. Options history. All right. The derivatives world can be traced all the way back to 624 BC, when Thales of Miletus was born, and he eventually, a very smart businessman, he predicted once that there was going to be a huge bumper crop of olives. So what he did, when he thought he understood the weather patterns and he predicted a huge crop of olives, he went around and took out the option to use several olive presses in his region and kind of corner the market on olive presses. Well, that's what happened. A huge bumper crop of olives. He had all the presses going, and he made a pile of money. That was one of the first recorded uses of options. And of course, you can have options on several things. And eventually, 1,000 years later, there was the famous tulip mania in Holland, where for various reasons, the supply of tulip bulbs plummeted, the cost began to climb, and people began jumping aboard and speculating in the price of tulip bulbs, to the point where a single bulb was worth like the value of a pig or something like that. It was just crazy, and then people began spinning off derivative contracts on the price of tulip bulbs, and the speculators lost huge on some of they were over leveraged. There was tremendous loss going on with many people there. And you know what happened is that the appetite for derivative contracts based upon the price of a commodity, the appetite plummeted, and it was considered to be a scam for hundreds of years after that. And really, it had a poor reputation all the way up until 1934, after the huge agricultural problems that, with the Dust Bowl and everything, the Great Depression, where it was ascertained that there really was a place for futures and options, derivative contracts, in the use of mitigating risk. And so the U.S. Investment Act of 1934 created the SEC, and it legitimized some of these derivative contracts. Now, for then decades, it existed only in the realm of contracts between institutions to help mitigate risk. And then in 1973, the Chicago Board of Trade spun off an organization called the Chicago Board Options Exchange. And the rest is history. The CBOE, or the CBO, is going strong now. The CME eventually bought all those parties, and today there are billions traded every day in options, publicly traded listed options. Okay, so that's a little bit about the history. What is an option? Let's just cut. And I like to use an example from real estate to describe this, because a lot of folks come to, and I myself am like this. I was in real estate. I had my own appraisal shop back in the 80s and early 90s, and then got into this in the mid-late 90s. And I've been at OptionVue here for over 20 years. But came from a real estate background. My father was in real estate, and so I like to use this as an example because it just rings true for so many people. Let's say that you are a speculator in real estate, and there is a vacant lot kind of on the edge of town, and it's worth $200,000. All right, and you feel that you could buy it and build something of value there and make a profit. So rather than shelling out $200,000 and buying it on spec, you instead go to the owner and you say, you know what, I got to go to the city, get approvals, I got to get the architect going, I got to hopefully maybe even find a buyer or a tenant to move into this building I want to build on your land. But I'll tell you what, I'm going to pay you $10,000. You're talking to the owner here. I'll pay you $10,000 so that sometime over the next 200 days I could buy the lot for $200,000. And I want the contract to be transferable. Okay, and the owner says, "Fine. You know what? I'll take that. I'll take your $10,000. I'll give you the option. So for the next 200 days, that's a go. No big deal to me." And so you obtain this option, and what happens after that? You start going around looking at what you could do, getting approvals and all that. And when you cut this down, break this down, we're going to call that $200,000 in the world of options. That's the strike price. Okay. You paid a time premium of $10,000, and the length of the days to expiration is 200. And so these are three terms we really need to focus in on when we start evaluating options. Now, after 30 days, here's how the story continues. It's revealed that a major retail chain is amassing land. We'll just cough and say Walmart, right? A major retail chain is amassing land, and it includes your lot. The estimated value now, you figure, is $300,000 instead of $200,000. So immediately overnight, looking pretty good. So you decide to sell your option to the retail chain, and they want to make you an offer for that. So what is a fair price for you, and how much is your profit? Okay, so let's break this down a little bit. Okay, all options are broken out in terms of two different types of value: intrinsic value and extrinsic value, or time premium. So intrinsically, the option you bought for $10,000 had a strike price of $200, and the land went up to $300. So that's a difference of $100,000. That $100,000 is what we would call intrinsic value. Intrinsic value. Now, separate from that, you paid $10,000, and there's still 170 days left on the life of that option. Still 170 days. Only 30 days have gone by. So you figure, you know what? There's still 170 days left. That's got to be worth about $9,000. I paid 10, and you know, there's still 170 left. That's figure that's worth $9,000. So your option, okay, is worth the 100,000 intrinsic plus the 9,000 for the time premium, or a total of 109. You paid 10,000 for it. Your profit when you sell it for 109 is going to be $99,000. That's the level of profit you have. Make sense? Okay. Now, let's now go and look at the example of a stock. Okay? XYZ stock is trading at $100 per share. Now, you could buy 100 shares and shell out $10,000, but instead you go to the options market and you say, you know what, I'm going to pay $4 per share. Each option controls 100 shares. Okay? I'm going to shell out $400 to control that same 100 shares. Okay? And it's in the days to expiration is at 100 days. Okay? And the option we're saying is transferable. You can always sell it and off it goes. You can sell it at any time to someone else that'll want to buy it from you. Okay? There's a liquid market for it. Okay, so those are the facts of the case here. Now let's break this down. What do you think happens? Well, sure enough, after 30 days, it's revealed that a major retail chain, perhaps the same one as the real estate, is attempting a takeover of the stock option, of the stock that you have an interest in. They're attempting a takeover at $110 per share, where the stock now starts immediately trading. Goes from 100 to 110. Okay? Your option is trading at $12.50 per share. So now you decide to sell your option. How does this break down and what's your profit? So let's break this down in terms of two types of value. Remember the two types? Intrinsic and extrinsic. Intrinsically, your stock went from, or the stock of the company went from 100 to 110. That's an intrinsic value of $10 a share. It controls 100 shares, so that's $1,000 of intrinsic value. Okay? $10 is the intrinsic. Now, extrinsically, where are we there? You paid $4. Okay, that was the time premium. Okay, it's trading at $12.50. We know that $10 of that $12.50 is intrinsic. That leaves $2.50. So $2.50 is the extrinsic value. So basically, folks, what you do is you'll look at an option price, figure out the intrinsic value, and whatever remains is the extrinsic. That's kind of how you do it. So when you pencil this out, it's $12.50 a share minus the $400, and so your profit is $8.50 total. Make sense? All right. Hope that gives you some kind of big picture view of this. Let's now go and look at the two types of options. You have calls and puts. Calls and puts. Let's look at calls first. And this is the standard definition, but let's just kind of break it down a little bit, because a call option, this is something a lot of people speculate in stocks when they think the stock is going to go up. So let's break this out. The call buyer, if you buy a call, you have the right, but not the obligation. You have the right to buy 100 shares of stock, and some calls control different numbers of numbers of shares other than 100. That's only in the case of mergers, typically, or acquisitions, where they break out a certain type of call. But we're going to put that on the shelf. Generally, it's 100 shares. Okay. You have the right to buy 100 shares of stock from the seller at a certain time, and there's always an expiration date. All options have an expiration date, and they have a strike price, okay, a certain price. You can buy it at a certain time for a certain price. Okay. The seller, the person that sells that call option, he's obligated to sell you or sell 100 shares of stock should you so decide to exercise that. And the buyer, you, pay a fee called a premium for that particular right to do that. Okay, so the person that sells the call, okay, and there's great strategies involving the sale of calls, and you can sell calls yourself instead of buying them. Okay, If the buyer exercises their right to buy that stock, that stock is then called away from you. Called away. And that's important to remember. CW, or CA, called away. The stock is called away from you if you sell calls. Now let's go to put options. This is where you can make money if the market goes down. The put buyer has the right but not the obligation to sell 100 shares of stock to the put seller, okay, at a certain time for a certain price. That's the strike price. The put seller, or the writer, writing and selling are considered the same thing in the world of options. If you're an option writer, you're selling it, okay? The writer of the obligation has of the put, you have the obligation to purchase the stock at that strike price. So if you sell the puts, okay, the stock is put to you. The stock is put to you. If you sell a put and then the stock goes down and you sold it and now it's going to be exercised, you have to then take that stock at that strike price. The stock is put to, called away. Okay? And of course there's a time premium affiliated with that. Let's take a look at the pricing here of calls and puts, and this will kind of make it more bring it to home a little bit. So here's a picture of OptionVue, and I'm looking at Apple when it was priced at 185 here a week or two ago. And in OptionVue, we'd separate out the calls here and then the puts down below. Okay, that's the C and the P. And the strike price, these are all strike prices. The strike price with that little triangle, that is the strike closest to being at the actual price of the stock. That is the strike that is closest to being what we label at the money. Now, it's very seldom you're going to have a strike that is exactly precisely at the money. It'll typically be a little bit above the strike or a little bit below. Okay? Now, the values of the contracts higher than this are considered out of the money. Okay, as you go higher, these are out of the money. You could buy the stock at 190, 195. Well, the stock is currently below that. See that? So these call strikes are higher than the current stock value. These are considered out of the money. And you would need the stock to really go high quick in 5 days here. That's what that shows you there. That's 5 days remaining in the life of those options. So you could buy this for 34 cents a share. You need the price of the stock to go up quick from 185 past 190. A good distance to make any money on that. So these are out of the money. The 185 is considered the at the money strike. And then as you go further down below, these strikes now begin to have intrinsic value. Remember that? Remember that? Intrinsic value. So let's take a look at this 180 call. It's priced at $5.50. Okay? Some of that $5.50 is intrinsic value, and some of it is extrinsic value. Okay? Let's just take a look at that. So if it's at 185.16, the strike is at 180. How far in the money is it? What is the intrinsic value there? Well, it's $5.16. $5.16 is considered the intrinsic value, and the other 34 cents would be the time premium or the extrinsic. I hope that makes sense there. Let's go to the puts now quick. In the world of puts, we go to the strike that is closest to being where the stock is trading, and that's at the 185 put. Okay? That's the at the money that we see here. And then if we're underneath this, these are the out of the money puts. Okay? So you could, down here at the 180, you could sell this 180 put, or you could sell the stock at 180, but it's currently at 185. You would need the price of the stock to go down past 180 a good amount for you to make any money on that put. You see that? Now these up here at 190, you could sell the stock at 190 or 195. Well, the stock is at 185, If you buy this for 190 at the 190 for 580, some of that is already intrinsic value. Some of that 580 is intrinsic value. The difference between 190 and 185.16. See that? Okay. So this is how you read the matrix in OptionVue, and it's important. And really, I would encourage you, if you get into options trading more and more, you really have to have a grid like this. It's like a chessboard where you constantly, and just live with it a little bit every day. It's like a language you learn. You got to immerse yourself a little bit every day completely, and you'll eventually start piecing together all this and being able to put together various strategies. But you have to really do this a little bit every day and get a feel for in the money, out of the money, and at the money options. Now in OptionVue, we have this column you can create here called time premium. Notice all the out of the money options, all their full price is occupied with time premium. The out of the money options, all of that value is wrapped up in time premium. Then when you get to the in the money options, a lot of that is intrinsic value, and the time premium then, begins to taper off the farther in the money you go. You see that? Okay. So again, you just kind of have to live with it and get used to the notion that the at the money options always have the highest levels of time premium, and as you go further in the money or out of the money, the time premium gets lower and lower the farther out or the farther in you go. These are the kinds of things you'll just get as you live in the world of options more and more. Okay, but there's tremendous possibilities here. Before we get to that, take a look. Each option in Apple has tremendous daily volume. Look at this. Thousands and thousands of contracts traded a day here in the near term options. Okay? And the open interest, OI, those are the outstanding contracts. So if you were to buy an option, just go in and buy an option in Apple, okay, that evening it gets added to the open interest. Okay, then when you close that and sell the option, sell it back, it gets removed from the open interest. So these are the outstanding contracts that are out there. A lot of the volume goes towards closing out positions, and some of them are involved in opening new ones. So open interest is a good way to look at the overall liquidity level of given strikes. Okay? Now, real quick, and then we're going to wrap this up with one other point after this. Just notice here that as we go further from left to right, we're going from options that expire in 5 days, 12 days. We're going farther out in time as we move from left to right, and as we do that, the time premium gets higher. See that? And in OptionVue, I would encourage you just to, if you get a trial of OptionVue, to play around with this. Look at how the time premium increases as you go farther out in time. Likewise, if you sell options way out here, as time goes on, the time premium goes down, and you could sell high and buy low eventually because of the sheer erosion of time decay, and that's displayed here in the matrix of options that you see before you. Some other possibilities, and these are for the speculators really like to predict huge moves, and if you accurately predict big moves in a stock or an index or an ETF or a future, you can really make a lot of money quick. And I'm just showing you, looking at the prices. Let's say you predict Apple in the next few days is going to go up $10. $10. How much can you make on some options here? What can you do if it goes up $10? And I'll just point you to this 190 call right here at 34 cents. If Apple goes from 185 to 195, this 190 call would be $5 in the money, right? If the stock goes to 195, this 190 would be $5 in the money. Let's see where the strike currently is that's $5 in the money. Right now, that 180 is $5 in the money. It's trading at $5.50. So give or take, you could see that you would buy this at 34 cents, and after a $10 move, it would be priced at $5.50. Okay? That's a pretty good profit. right? That's a pretty darn good profit. That's a gain of about 100 and what, 10 times, 10, 15 times your money right there. And so that's the kind of possibilities you can have in the world of options. You could go down and on the puts, you could look at the same thing and see if the price were to go down $10, where it would be. And you can just kind of see a tenfold gain down there. So just pointing that out to you, and then you can ascertain a lot of that just the more and more you live with these option prices. Again, here's our philosophy. If this is something that you want to commit to, we're here to help you. I want to show you something we're offering right now. And we just packaged this up for folks wanting to get up to speed quickly from a very beginning level up to an intermediate level. We have an Introduction to Options course for $999. We give you access to 6 courses. And what you'll do is you'll take 2, do the homework, and meet with a mentor. In this case, you would meet with Ken Dole for your first session after doing the homework for the session I just showed you, and you could watch the recording. We also have long calls and long puts. We'll show you what calls and puts to purchase if your long-term or short-term perspective is varied, and we give you some direction there. The second session you'll have is with Steve Papali after you examine covered call basics and campaigning, as well as how to search for 1-month covered call trades. And we give you a scanning tool called OpScan to help you do that. And you'll do the homework on those 2 sessions and then meet with Steve. And finally, you'll meet with Frank Fahey after exploring protective puts, married puts and collars, and naked put selling, where we give you some scanning tools for that as well. So that's 3 mentoring sessions on 6 recordings with homework. We give you 3 months of OptionVue with delayed data and the scanning, and then access for 3 months to my 500 sessions of Inside Wire broadcasts that include just a ton of research I've done for the last 10 years, and it's really an unlimited amount of listening, and each of them have PDFs, everything for your examination. And it's just a ton of learning for you to do, but we really want you to consider this because you're meeting with some excellent mentors who trade options themselves, some professionally managing money, and it's something I think that would really help get you up to a good, solid intermediate level very quickly. If you have any questions, okay, you could give us a call here, 847-816-6610, and to purchase, you could either buy it online from the folks here, the reps here that would speak with you, or you could go online to Discover Options, click on the curriculum area, okay, and under the Introduction to Options, there's the $999, and you can just click the buy and go into our store and purchase it there as well. Okay. Any questions at this point? I see Jim's been on a little bit. He's still with us, and there we go. Thanks, Ron. Yep. Just want to be up front and lay it all out. But the real value here to us, we feel, is the progression that we take you through. For the folks that are serious about getting to a strong level quickly, I don't think there's any better way. Otherwise, you're kind of floundering a bit out there. We give you a clear progression, a clear set of topics to get you through the beginning stuff into an intermediate level, and then we have a more advanced level to take you to the more advanced strategies with the income type trading that I showed you about at the very beginning. But just look for any comments or questions, and then we'll wrap this up. I usually don't like to prolong it at the end. I like to just lay it out there and give you the phone number, and please give us a call. We would love to have you join us and participate with us in our sessions here. All right. Okay, excellent. Folks, 847-816-6610. Thanks for joining us. We'll talk to you later next time. Bye-bye.